We're going shopping for energy and materials dividends on this energy edition of Industry Focus. Greetings, fools. I am Sean O'Reilly here in studio at Fooling headquarters in Alexandria, Virginia. It is Thursday, November 19th, and this week is Dividend Week on Industry Focus.
Dun, da, da, da.
Dun, da, da, da.
Hey.
Yay.
Hey.
Joining me, and whose sultry voices you just heard, are Tyler Crow and Taylor Muckerman. What's the good word, boys?
Well, we were just talking about a whole lot of Carolina Panthers.
Whole
I
lot
was
of
about to
Carolina
say,
Panthers.
is
Keep
their
pounding.
year?
Ask Taylor. He's the Carolina
this
Panthers
it?
fan.
It could be rematch of 2003.
Good year to be a big cat, I think, is the trend I've seen.
Well, yeah. So the Bengals are out.
Yeah,
So just
wow,
the Panthers and apparently the Cheetahs are still
Who would've
left.
thought?
The Cheetahs.
Who would have thought?
It's a little GIF I saw the other day.
Yeah. You have to send that to me.
New England Cheetahs.
Cheetahs. Cute.
Oh, that's what I saw.
Yeah.
Whatever.
Oh, my God. Did you see how the Patriots won over the weekend?
Yes. I hated it. We need to be the best team for once.
I know. I feel bad for Eli and just the whole...
Whatever.
I don't know.
Yeah, my dad's a Giants fan. He was not a happy
Did
man.
he...
Not a happy
Were
man.
TVs broken? Like...
No, his whole
It's
thing
not the
is
Super Bowl.
It's
but
always
it was
the thing
a
is
rematch.
when the Giants aren't playing well, he goes down and cleans the garage. The garage was spotless after last
Beautiful.
Sunday.
It was
Spotless.
swept. The shelves were organized.
Oh, yeah.
Everything.
It was beautiful.
Awesome. So moving on to the energy sector and dividends. Other shows, so far this week have highlighted, American brands like Johnson & Johnson, Philip Morris, like storied American brands that we all know are just going to pay off tons of dividends and cash flow and all kinds of good stuff. We have a little bit tougher of a job because our sector's not doing so hot right now, and it is extremely cyclical. In your opinion, what's the biggest challenge to investing in energy and materials for income?
Well, I think what you just said there is a really important thing that energy and materials just doesn't have. You, like you said, Johnson & Johnson, Philip Morris, thinking of Coca-Cola, storied brands. They have that ability to brand, and with brand comes pricing power, and that is an extremely powerful thing. You can just be like, oh, we're going to raise Starbucks, we're going to raise 50 cents, and nobody says
Which
a word
they do.
about it. And they do routinely. You can do that with cigarettes. You can do that with a bottle of Coca-Cola. Unfortunately,
Get me ExxonMobil crude. I only want ExxonMobil
There is
crude.
no such thing as branded product in the energy and materials space. It is a commodity, and you could say that somebody like an ExxonMobil has a recognizable name, but it doesn't mean that what they do is going to generate a premium simply because of that. And without that pricing power, and like you said, we're much more subjected to commodity prices in energy and materials. It makes it that much harder to get that routine, day in, day out, increasing revenue, increasing profits, increasing dividends.
Any thoughts?
Yeah,
Anything
that's
to add?
pretty much it.
That was it?
Yeah, it's tough.
Want to keep talking about the Panthers?
Oh, we could. They're winning.
No, we need to give the people what they asked for. That being said, is it possible for anybody in the energy and materials space to... I mean, we all know kind of the answer because there are some energy and materials names on the dividend aristocrats list that we'll talk about later. But is it just about cost cutting? Like, what does it take to make it to a dividend aristocrat status as an energy or material name? Is it just about cost cutting? Is it about vertical integration, which we were also talking about before we went on air?
I mean, prudence, foresight, consistency.
Crystal balls.
Yeah, well, somewhat. I mean, some companies do have better insight because they have a larger customer base. They're involved in greater geographic regions, so that diversity is there. Some people are more integrated, so you have companies that have refining and they have upstream, so they're a little bit more balanced there. But yeah, I just think prudence in times when times are good, and gives you some more flexibility when times are like they are right now. And there really aren't that many names on the dividend aristocrat list, and like you said, we'll talk about it later. But they're mostly utilities, which is a fairly stable industry. For now, who knows the disruption that solar and wind power and renewable energy will cause? But for the last 100 years or however long, we've really been relying on coal and natural gas power and steam power and everything. Utilities have been the real only consistent dividend payers in the energy industry.
And surprisingly, they haven't done as great as I think so many people say. I mean,
I think it's one of those just old tales.
Well, it's regulated. Regulators
Yeah.
try to basically guarantee a
And
certain
at one point they
return on
were
capital.
able to grow, but
Right.
population in the U.S. is kind of stabilized, so we're not in need of so many new power plants as we were back in the 40s, 50s, 60s when the baby boom was coming on. And now all those folks are old. They're living in their houses. They have kids, but they're having kids at a lesser rate. Even our generation now is having kids at a lesser rate than that. So you're seeing population
throw in energy efficiency,
Yeah,
and
energy
you're looking
efficiency.
at
Game over, yeah.
flat to 1% electricity growth. And if you even look at like what you'd call the storied names in utilities, you think of somebody like a Southern Company, a Duke Energy, somebody like that. They've cut their dividends actually multiple times in the past 10, 15 years.
Did they do
And-
any? Because Taylor was talking about prudence and during good times and everything. Did they overreach? Like get into natural gas when it was the $13? Like what?
Well, these projects take forever to build, so sometimes it's not overreaching when it takes place. But if 5 people have a nuclear power plant or a big coal plant coming online in the next 5 years, and they all come on that line at once, they're like, well, we didn't really expect that to happen.
Oops.
So
So
it's-
much for that one.
Yeah, had 1 or 2 of them come online, sure, they'd be sitting pretty, but everybody wants a piece of that.
Which is exactly what we see across so many other energy and materials. I mean, we could talk about the commodities boom of 2011 where everybody let's talk about iron just for a second.
Yeah.
Iron ore, over the past 3 or 4 years, companies like BHP Billiton, Rio Tinto, things like that have been plowing money into new mines, and all of a sudden they're all coming online now at, we could say an inopportune time in terms of demand, but at the same time, bringing that much on at the same time, oops, too much.
Game over.
And you have the
Yeah.
strong dollar, so it impacts a lot of these
Right.
emerging markets where these metals are coming from. And oil is priced in the U.S. dollar, so it's more expensive internationally now. So yeah, it's
Are energy investors just out of luck when it comes to dividends? Like, what should we be avoiding these days? Like, what do we need to avoid? Because then we can kind of narrow it down.
cash flow, free cash flow. You want to see consistent positive cash flow there, so that kind of takes into account
Over a decade, like what do we?
No. I mean,
Like,
yeah, a
what can the
decade will
layman
smooth
do?
out maybe a cycle or so, but when you're on an upturn, generally I just look at the near term because they darn better be able to pay their cash flows then and there because this is the best time to be able to
Right.
have cash flows. In the downtime, that's when I would look at lengthen out the time frame a little bit because hopefully this bear market in oil isn't going to last forever. So if you just look at the last year, cash flows have just been destroyed. So you would expect that to turn around. So maybe look out to see how they've done in the last 2, maybe 3, maybe 5 years. So that way you can get a better picture of what they've been able to do. But in the markets where things are soaring, like Tyler said, 2011, 2010, if they're not handling their business in the last 1 or 2 years, then
Stay
they're probably not going to handle it when the cycle turns south.
Cool. Before we move on and going along with this week's income focus theme, I wanted to point our listeners to a special article written by 5 industry focused contributors detailing their top picks for dividend stocks. Just head to dividends.fool.com to learn our picks for the best dividend stocks for 2016. Once again, that's dividends.fool.com, and just to make it easier on everyone, I will drop it in the iTunes description of this podcast.
You're a swell guy.
Yeah, making it so easy
such
for
a nice
all of
guy.
our listeners.
Such a nice guy, Sean.
I go above and beyond for our listeners. So we've talked about, what to avoid and how really there's not a lot of multi-decade dividend increasing energy material stocks. It's really, really hard because it's a commodity business. What are some traits that the average guy can look for, guy or gal, I apologize, in companies that can maintain and consistently grow dividends?
Well, like you said with cash flow, it's the ability to preserve your cash flow based on your business model. Like we talked about vertical integration for somebody in energy space where when one is weak, such as when oil prices are cheap, then all of a sudden refining becomes a more profitable venture, and then vice versa. So you have a kind of a smoothing out of the cash flow. And you could also look at, even in the energy space, surprisingly, there are a lot of companies who aren't directly exposed to commodity prices, and they're more based on the more generic supply and demand. You look at somebody who specializes in transportation and logistics. I think if you work in those middlemen sort of ranges where you're working off of contracts, where you're working off of a way of only charging for volume that moves through your system, and if in terms of the utilities and things like that, the ability to get a little bit closer to the customer, where you don't see as wide of swings in price as you may see, on the kind of the front end when it comes to the generic material itself. So those sort of things will help isolate a company's cash flow from the cyclical aspect of this business, and that can actually help to preserve its dividend in a much more stable way.
Yeah, and just to kill the suspense, and diving down to the energy dividend aristocrats, it bears out exactly what you're talking about. I mean, you got Northwest Natural Gas, they're a distributor. Helmerich & Payne's a rig owner. Consolidated Edison, that's like the quintessential utility. MGE Energy, same deal. Atmos Energy, natural gas distribution utility. ExxonMobil, the integrated of integrated. Energen Corp, it's an oil producer, but they actually just recently cut their yields, so it's probably take them on the list. And Chevron, another integrated oil producer. So is that where people should be looking for dividends, guys?
I mean, if you want a company that's just going to plod along in the markets and pay consistently rising dividend, then sure, yeah, that's great. But you're not going to see a whole ton of capital appreciation from these companies.
Right.
But at the same time, I mean, there is a lot of power in that. I think one of the things that's underappreciated, when we talk about dividend stocks, we always think of them as an income stock. That idea where it has to be somebody who is looking to use the dividend to simply, pay for lifestyle or supplement income in retirement, something like that. But for younger investors, dividend investing can be extremely powerful in that dividend reinvestment model. And, we may look at it and say, oh, these companies don't grow at a very fast clip. However, from an individual investor standpoint, that reinvested dividend model on some of these companies that have shown year in, year out that they can do dividend payments and dividend increases, that can be a pretty powerful tool for building wealth.
And if you're holding it for 20, 30 years,
Well, yeah,
you can almost get the stock for free, essentially, is each dividend. If you look at a dividend instead of income, if you look at a dividend as lowering your cost basis, each dividend you pay, you get the
really
stock for
attractive,
cheaper.
yeah.
So, yeah.
What was that statistic over the last 100 years? Like, some huge chunk of total returns have been from dividends. It's like 40 or 60% of total returns in the stock market.
Well, yeah. If you look back over the last 5 to 10 years, the increase, I think it was like 120% of cash flows have now been paid as dividends or share buybacks, up from like 60% just a handful of years ago. So it's become a financial engineering tactic for a lot of companies lately, and some people are worried about that reversing and harming the value of the stock market. But it's become a very important part of a CFO's job to pay dividends and buy back shares.
So before we head out here, any companies on the above list that you guys like in particular that you want to highlight or maybe aren't on the list? Like, I'm sure, Tyler,
I'll let Taylor start it off. It doesn't even have to be on the list.
Oh, yeah, on the dividend aristocrat list, I'm personally not going to invest in any of those companies. Dividend payers in the energy sector that I like. I mean, the ones that I own, Halliburton, I'm not trying to talk my game, but I own it because I like it. So that's one of my favorite dividend payers.
And they're, of course, integrated.
Well,
huge
they're
exposure to.
Yeah, so they're the equipment and services provider, offshore, onshore, natural gas, oil, predominantly fracking. So once that picks up, and it hasn't even started to pick up really around the world, so I'm expecting that to be a nice decade or so tailwind once China and Argentina and others get on board with fracking, because it's going to have to happen at some point.
Cool.
Well, since I do own ExxonMobil, I guess I'll have to say that one since it is on the dividend aristocrat sort of level. The reason that I do like ExxonMobil over the long term is when compared to many of its peers, when they're building out their projections on how to develop new fields, they have a much more conservative approach in terms of at this certain price point, we have to have at least break even or a certain amount of return. And for ExxonMobil, that's about $55 compared to 60, 70 range for most of its integrated major peers. It has the reputation for years now, decades even, of being the one company that invests through the cycle. So, it's not trying to push a whole bunch of projects out the door when cash flows are great and then, shutting down when things get weak. And it gives them that level of consistency that I think most investors are looking for when they're looking for that income sort of play.
Cool. Well, that is it for us fools. If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. As always, people on this program may have interests in the stocks they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear on this program. For Taylor Muckerman and Tyler Crow, I am Sean O'Reilly. Thanks for listening, and Fool on.